Now, back by popular demand, it's the Lance Roberts Show.
I feel like you should do the risky business thing and just come sliding into the screen as we open up the show.
Kramer.
Exactly. Good morning. It is 6:07 on this Friday Eve edition of the Lance Roberts Show right here at realinvestmentadvice.com. We've got a couple of big articles out today. We've got a conversation with Carolyn Baum coming up this morning talking about corporate debt. One of the issues is, and I've got an article about this morning, it's on the website right now if you go to realinvestmentadvice.com, is talking about the issue of corporate debt. And of course, the low interest rate environment for nearly a decade has led to a big surge in corporate debt. But there's a lot of similarities between the corporate debt and what we saw back in 2007. So we're going to have a conversation this morning for a few minutes with Carolyn Baum. She's the journalist for Market Watch and a good friend of mine. But we're going to talk about some of the issues surrounding corporate debt and what's going on and why there's some real implications to that as well. One of the big triggers to this, of course, ultimately is always a downturn in the market or a recession, which ultimately leads to an ability for companies to get locked out of the ability to refinance their debt. That's always the big risk. But talking about a downturn in the market, we've talked about this for a while here. Over the last few weeks, so as this market was kind of running up towards all-time highs, we said, look, the market's getting very extended here. Time to take a little bit of money off the table. Just do a little bit of, household cleanup. We talked about the similarities to, having a garden, and that sometimes you've got to weed the garden. Sometimes you got to go harvest some bounty out of the garden, because if you don't, well, your tomatoes just rot on the vine. You don't get to enjoy eating them, right? That's the whole purpose of why we invest, is to, grow some nice bounty so that we can enjoy it and use it down the road. But if we don't harvest every now and then, we wind up losing those profits. So it's one we talked about a couple of weeks ago. We took profits out of our portfolio because it's we never know when these if we go back a little bit for a few days and talk about where we were last week, the market's going up. There's absolutely nothing to worry about in the market. Everything looks fine. Employment numbers are good, economic numbers are good, and we never know what's going to be the trigger. But we know that when markets get extremely deviated above their long-term average, and I had talked about this on the show a few days ago, that when these deviations occur, there's always a retracement back to those averages, right? They're like gravity, and it pulls those prices back. And we never know at the time when we're talking about these things, like, hey, the market's really extended here, take some money off the table. Everybody goes, well, why? Everything's so good. Because there's always a reason that things happen. And, Friday, of course, this weekend, of course, was Donald Trump talking about reinstating tariffs because China's not playing nice in trade. Surprise, I told you this was going to be the case about a year ago here on the show. I said, when we started this whole thing, don't expect China to acquiesce to all this. They've got no intention of doing it. So, no surprise here that China's kind of reneging on their deal at this point. They got what they needed, which was the ability to get their markets back up and to higher levels. The U.S. rebounded nicely off the lows here on expectations of getting a deal done. Everybody got what they wanted. But now there's no reason to really go through with the deal at this point. It's kind of like, buying a car that you really can't afford. You go look at it, and then, right when the guy says, well, you ready to sign for it? You're like, yeah, well, I really, can't afford it. I just wanted to come test drive it. Well, that's what happened here. So this tweet on Monday over the weekend has pulled markets back to their current moving average, right here at the 50-day moving average. What's going to be important today is, and of course, I wouldn't recommend doing anything. The initial kind of impetus here is to jump in here and buy the market as we get close to this moving average. But I'd be a little bit cautious here because, again, not knowing how this trade negotiation is going to work out on Friday, an additional input of more tariffs, an increased rate of tariffs, and then additional potential tariffs coming, there is definitely more downside risks in the markets than not. And again, it's important to look here that, here we are, last January, and, the markets have really been at the same place now for where we've been since last year. So we haven't really gone much of anywhere in almost a year and a half. But importantly here, there's a lot of support right around this area at right around 2,800 on the index. So that's really kind of the key area we're looking at right now. If we break that level at 2,800, we're probably going to be looking at 2,770 to 2,750 on the S&P 500. We get below that, we're going to have some real problems here this summer. And as we get into summer months, we're going to see weaker economic data as well, which is going to put some downward pressure on stocks, at least here in the short term. One of the other issues here, of course, in the short term is that we are getting back to very oversold levels. So this oversold condition does suggest that, there's potentially going to be a bounce here next week. So again, if you're a little bit, and we talked about this before, is that, when you get very, very, overly aggressive in portfolios, it's fine as long as asset prices are rising. We kind of wake up and realize that fact that we've got too much risk when markets decline. So if this recent decline this week has really kind of gotten you, kind of worried at night a little bit, staying up, worrying about your portfolio, if you're checking it more often than usual, we are getting fairly oversold here. So expect a bounce next week. Use that as an opportunity to kind of rebalance risk in portfolios. It's just always a good idea to clean house and, just have things the way they're supposed to be. It reduces risk. And the biggest problem for investors long term is not really the fact that, when these markets decline that they sell. The issue is that they tend to do this on an emotionally based basis. And this is why we talk about having an investment discipline. Here at our shop, we write a lot on our website. If you go to realinvestmentadvice.com, we write often about having rules. We publish our rules on a regular basis. We just did this last Tuesday, put out our trading rules for managing your portfolio. Those are all on the website now at realinvestmentadvice.com. But, having a discipline, a strategy, how to control risk, how to control loss, that's what makes you more profitable as a trader long term. Warren Buffett, the great traders of our time, Paul Tudor Jones, Ben Graham, none of them ever bought and held securities long term. They bought value, they sold when there was no longer any value, and they understood how to control risk. And once you start doing that, you'll have better success as an investor long term. Quick break, we'll come back. We'll pick up with Carolyn Baum talking about this debt issue right here on this morning's show of The Lance Roberts Show, right here at realinvestmentadvice.com. Don't go away.
Catch The Lance Roberts Show anytime, day or night, online at lancerobertshow.com.